Alright, so this is how you can trade gold futures, so you can pass your Top Step account or any account, to be honest. Futures, prop firm. So, voice crack of doom. Alright, so what you want to do is head over to 30-minute chart. Actually, yeah, let's just go to 30-minute. To be honest, you don't really need to go higher than 30-minute. I think 30 minutes is good enough. If you're just gonna be trading based off what you see from 9:30 till 4, but obviously you can go higher if you're gonna be trading pre-markets, because that's usually when we get big fat juicy moves. But alright, so let's go over here and see. So what you want to do is mark out like supply and demand zones to see where we can bounce or try heading to. Right off the bat, we can see we have this supply zone right here. We just want to mark it off. I just use a little clear white box for the 30 minutes, so it's not too much pressure. I like to use the colored boxes on lower time frame and whatnot. Alright, cool. Now, what else do we see? We also see that we have a significant one down here, which is a demand zone. So, cool. We have the top one, the bottom one. Now, you can see in here, there's got to be one more, which would be this one right here. So we have a top, a middle one, and a bottom one. Now, sometimes price can bounce off of the little tiny ones as well, but we're gonna have to go to the lower time frame for that. So let's go to 5-minute. Okay, cool. So now we see we have a demand zone here, and how you would mark it would be you go from a supply zone. You would mark it from where it opened or closed to the bottom wick. You never want to mark the top wick. Let's go with the blue box. So that would be our demand zone, at least one of them. Now, a supply zone, for instance, here would probably be this one right here from this candle, because you can see it kept reacting with it. So let's do this one red. If you don't want to get too intricate with the supply zones, it was just from this candle. What you could have done as well, it's the same thing, because price reacted with it, would have been from this candle here. So I'll just leave it here. It's the same thing either way, from here to here, or a little bit lower. But that would be our supply. And then we go down to 1 minute. And for instance, here, if you were trading, you would have kept looking. My screen. Yeah, now my screen froze. I don't know what I cut out, but let's just see. When you're trading gold, what you want to see as well is, where is it at? Okay, here. You want to see smaller time frame supply and demands, especially on the 1 minute. You can see here, boom, tapped in. What happened? Breakup structure, retracement into this supply zone. Now you can see these are perfect entries. Boom. You could target other demand zones as well. For instance, here, boom, we bounced off of here, boom, boom, and once we broke through this one, you can see we had just went boom, straight down. And then you would have to use other ones from over here, other demand zones, to see where we were gonna bounce. And then once we build up this little floor or double touch, you can be like, where is it? Let me do a different color. Once it comes up and then does a little double touch, has a good possibility of it going higher than this previous high right here, or lower high. But another way you could do it, because obviously you can see here, this was the break of structure right here. So what you could have done is waited until price moved above here, or you would have had another entry if you would wait above here. So whichever one you think is less risky, then go ahead. Personally, for me, I've been sort of used to the floor is just what I call it. It just goes up, boom. It's like a double bottom. It's putting up that floor. It's in a demand zone. You know, why not take it higher and just target these highs, or target any of these highs up here, and you would mark out the demand zones. Now that price has changed, and then you would just keep marking them out. Now, another thing I was gonna say is, where is it? Let me try to find an example. For instance, here, this right here is a good trade you want to look for on a daily basis. You can see it. Price is sort. This is obviously the demand zone. You see, we wicked out, and then come back up here to the supply zone. Now, just because we closed under here, we can assume that it's a break of structure, because price kept reacting off of that, and then it comes back up to retest the supply zone, and then guess what happens? It falls at least to the bottom of where we had that big initial move, which does have a bottom wick. It would have been somewhere here. It's not always gonna be perfect, but you just gotta know. You gotta like guess it. And then here, where is it? So you just be looking at supply and demand zones, and you really just see where price is gonna bounce. You can see here, every time it came up here, you would have sold. Guess where it went? From that supply zone all the way to this demand zone. So it goes boom, boom, break of structure, retest. That's also a good trade you want to take, break of structure and retest with gold. But gold works really good with supply and demand zones. And then if you use indicators, I'll make another video for that. But that's how you can just use simple demand and supply zones to market. I think I said for supply zones, what you want to do is mark the bottom of the wick, the bottom of the candle, wherever we closed or opened, to the top of the wick, never the bottom wick. But yeah. And then a lot of people are like, oh, fair value gaps work, like boom, boom, boom. If they actually worked, then, you know, I guess sometimes market, it's not always gonna do it consistently, but guess where, like, we went up to? People are like, oh, I filled it in this fair value gap, which yes, it kind of did, but in reality, we can also just see that this right here was just a huge supply zone. Like, we came back up, tested it, boom, came back up, tested it. It's sort of like the head and shoulders, which I don't think is, I just don't know why they're a thing. Like, let me try to look for an example. Let me try to look for head and shoulders. Like, maybe here, boom, 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 boom. Like, I'm pretty sure in the head and shoulders, where would you have gotten in? You would have gotten in, like, where's the break of the neck? And I'm pretty sure this is, hold on. Let me try to click here. Yeah, okay, let me see. Okay, so here, you technically would have gotten in, where's above the neckline? Wait, Okay, I see. So you would have gotten in around, technically here, you would have gotten in based off from my understanding of head and shoulders, which would have been boom, 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 boom. Well, what you could have done is just drawn out a demand zone like this, and then you would wait, boom, boom. So you can tell we're going higher and higher. Like we're not, it's not, price isn't falling lower than these right here. So then boom, then you could have just waited, gotten in, took the risk, and you could have targeted these highs right here. I'd just like to do where the candle closes, to be honest, just for safety. And then boom, boom, and then your risk just would have been here, from here to here. Maybe a little bit higher. Like, that's a pretty good risk to reward, in my opinion. Like, demand and supply zones aren't, super duper risky. And you can see this candle here. What could you have done? Do you see this? We would have gotten here. Obviously, sometimes we're gonna wick out. So if you want to put more risk, then that's totally fine. You can do it to the next demand zone. Should have been right here to the bottom of that. Let me change the color. I can't really see the bottom. So as you can see, this is the risk to reward for both times. Technically, look at that. That's pretty good. 3.89. That's not bad for 1 minute too. But yeah, that's how y'all can trade gold. Nothing too complicated. No indicators. No nothing like that. But you can if